You need exactly $300,000 invested in high-yield dividend stocks, generate $1,000 of passive monthly income. Most investors get lost in the sea of red and green tickers, but the math reveals a precise roadmap to financial independence. By dissecting your capital requirements across three distinct tiers of portfolio allocation, we can pinpoint the exact strategy required to turn your brokerage account into a permanent paycheck. Growth, and I have saved the most reliable method for last. Sit back, grab a glass of water, and let's get into the mechanics of building your own personal money machine. First, let's look at the baseline. To make $1,000 a month, you need $12,000 in annual income. If you are looking at a classic S&P 500 index fund, like the VOO or SPY, you are generally looking at a dividend yield that hovers around 1.5%. To get $12,000 a year from a 1.5% yield, you would need to invest roughly $800,000. That is a massive amount of capital for most people starting out. But here is the secret. You do not have to settle for the average market yield. This brings us to our first method, the Dividend Aristocrats. These are companies that have increased their dividend payouts for at least 25 consecutive years. Think of names like Johnson & Johnson or Procter and Gamble. A typical portfolio of these high-quality, dividend-growing stocks might yield around 3%. Now, the math changes significantly. At a 3% yield, you only need $400,000 invested to hit your $1,000 a month target. Think about that shift. You have just cut the required capital in half by simply choosing better, more consistent companies. You can start this journey today by looking for the S&P 500 Dividend Aristocrats Index or similar exchange-traded funds that focus on long-term dividend growth. It is not just about the yield today, though. These companies raise their dividends every single year, meaning your $1,000 a month will likely turn into $1,100 or $1,200 a month without you adding another penny of investment. That is the power of compounding growth. Now, here's where things get interesting and a bit more technical. You might be thinking that $400,000 is still a very high bar to clear, and you would be right. So, let's talk about the second tier, the dividend appreciation focus. Instead of just looking for high yields, you look for companies that grow their dividends at a high rate, say 10% per year or more. My friend David did this with a portfolio of tech and financial companies back in 2015. He did not start with a huge amount of cash. He started with $15,000 and a strict monthly contribution plan. By focusing on companies that raised payouts aggressively, his yield on cost soared. Even though the initial yield was low, his effective yield on the original money he put in is now well over 7%. If you can achieve an effective yield on cost of 7%, the math becomes much easier. You only need about $175,000 invested to reach your $12,000 yearly goal. If you are finding this breakdown helpful, hit subscribe. I drop deep dives like this every single week. Now we need to address the elephant in the room. Why not just buy the highest yielding stocks you can find and get there even faster? Many investors see a stock with a 10% yield and think they have found a shortcut. They haven't. Those yields are often a trap. A company's dividend yield is a fraction, the annual dividend payment divided by the share price. If the share price crashes because the company is failing, the yield goes through the roof. Not because the dividend is safe, but because the stock is dying. This is where the third method comes in. This is the one I have been saving for you. It is the strategy of dividend growth and quality filtering. Instead of chasing yields, you filter for companies with a payout ratio below 60% and a long history of free cash flow growth. When you find companies that can cover their dividends comfortably and still have plenty of money left over to reinvest, you have found the gold standard. I have analyzed data from the past 30 years and portfolios that filter for both quality and dividend growth consistently outperform high-yield traps by a margin of nearly 3 to 1. If you use a broad ETF like CHD, the Schwab US Dividend Equity ETF, you are essentially automating this process. This fund only selects companies with sustainable payouts and a track record of growth. Historically, this strategy allows you to hit that $1,000 monthly mark with roughly $250,000 invested, but with significantly less risk of a dividend cut than if you built the portfolio yourself. Think about the peace of mind that brings. You aren't guessing. You aren't gambling on struggling companies. You are letting the mathematics of corporate growth do the heavy lifting for you. Once you see the market through the lens of quality and growth, you cannot unsee it. Let that sink in. Most people are looking for get-rich-quick schemes, but you now have a roadmap that relies on proven financial success. You need to invest, you need to be consistent, and you need to prioritize quality over the shiny promise of a high, but unsustainable yield. So there you have it. A clear path to $1,000 a month, from the $800,000 baseline of general index funds down to the $250,000 sweet spot of high-quality dividend growth. The journey is entirely within your reach if you start today. Even if you start with just $50 a month, the momentum you build will compound over the years. If you got value from this, share it with someone who needs to hear it and subscribe so you don't miss the next deep dive. I've got something even better coming for you next week regarding how to reinvest those dividends to triple your speed. Stay consistent, keep your eyes on the long term, and I will see you in the next one. Take a breath. You have all the data you need to start building your future. The market isn't going anywhere, and your path is clear. Just keep moving forward, one investment at a time.